Hello and welcome to Business 360. I'm Shireen Bhan. The headlines we're tracking for you this evening. The Sensex and the Nifty end with marginal gains even as bank stocks decline. Mid-caps outperform oil marketing companies gain as crude oil prices hit a 3-month low. More relief measures and sweeteners from the union government are on the anvil in the run-up to the general election. Sources say the government is retaining its fiscal power and there is no question of undershooting the FY24 budget estimates as revenues remain buoyant. That's an exclusive. The government weighs import duty cut on fully built electric cars if a company commits to manufacturing in India. Sources say a high-level meet at the Prime Minister's office discussed ways to incentivize electric vehicles and attract players like Tesla to make in India. That's another exclusive. In an attempt to check China's influence, U.S. International Development Finance Corporation will invest $530 million in Sri Lanka's Colombo port terminal run by Adani. This is the first investment by a U.S. government-backed agency in an Adani project. Leaders of the G7 nations issue a joint statement calling for a humanitarian pause in Gaza, even as they support Israel's right to self-defense. Red Cross says aid convoys headed towards Gaza were targeted. More than 10,000 Palestinians and 1,400 Israelis have died in the last 32 days. India's largest domestic carrier, Indigo, says it will have 30 to 35 of its planes on ground by March, taking the total number of grounded planes to 75. The airline tells CNBC-TV18 it has retained older planes, extended leases on 36 planes, and is taking 23 more planes on lease in November and January to offset the impact of grounded planes on its operations. Air quality remains hazardous across Delhi and large parts of North India. The Delhi government announces an early winter break for schools. After a wrap from the Supreme Court, Delhi decides to implement the odd-even scheme only after the court rules on its efficacy. This October was the hottest month on record globally. It was also the 5th straight month of record heat. This virtually guarantees that 2023 will go down as the hottest year in recorded history. Well, first up, the day's market action. It was a range-bound session today. We saw the Nifty and the Sensex end with minor gains. Reliance, Infosys and L&T batted for the bulls, while ICICI Bank and Infosys were the drags in the market. Let's take a look at the picture. 19,443, that's where the Nifty closed for the day. The Sensex just about in the green, up 33 points, closing flat. Reliance Industries higher by about 0.5%. Infosys down by about 1%. Mid-caps did rally about 1%, but banks continued to underperform, and the bank index ended mildly in the red. That's the story across the mid-cap, up by about 1%. The Nifty Bank down by about 80-odd points. That's the story as far as the markets are concerned.
The penetration levels are so low and the need is so high. The entrepreneurship is so high in the country, whether it is SME financing or microfinance or housing
all finance
financing
banks
or personal credits. The growth seems immense for disciplined company. I'm not talking about hubris. It is very, very careful risk management, great deployment of technology, measured growth, well-capitalized balance sheet. It is an endless growth journey.
You know, from our perspective, we are playing, let's say, if you look at Digital India as a theme, because we manage multiple strategies, we are playing the Digital India through who is going to put the infrastructure for Digital India to really thrive. And therefore, we have a specific data center fund, which is building out data centers. And with the advent of 5G and AI, the data center demand is likely to explode.
Well, that's the story as far as the markets are concerned. On to the commodity market action. Crude oil prices down to their lowest level that we've seen in 3 months. This because they've been weighed down by concerns over waning demand in the US and China. A steep build-up in US crude inventory and mixed data from China weighing on sentiment, so crude at a 3-month low. On to CNBC-TV18 exclusive this evening. The government is likely to continue announcing relief measures and sweeteners in the run-up to the general elections next year. This as per sources who say that the centre is retaining its fiscal power and there is no question of undershooting the FY24 budget estimates as revenue remains buoyant. Sapna joins us now with more. Sapna, there have been many announcements, including the announcement of the free grain programme continuing for another 5 years by the Prime Minister recently. What more is likely? What more is on the anvil?
Well, what we have been given to understand very clearly is that some more policy announcements from the government are likely as a run-up to the general elections, and maybe December, Jan is when you can expect them. Even in the recent past, there have been a series of announcements, and as of now, the government clearly retains its fiscal firepower. Revenues are also buoyant, despite the fact there is a bit of a dip in disinvestment receipts. So in the recent past, the extension of the Pradhan Mantri Garib Kalyan Ann Yojana for over 5 years, increase in the LPG subsidy, also the intent to bring out a new home loan subsidy scheme for city dwellers. All of these are very clear indications that they want to, provide some succor, some relief to the common voters. Even in terms of price management, the announcements made in terms of managing cereal and vegetable prices, and Bharat Atta being available at 27 rupees a kilo, subsidized rates. All said and done, H2 spend is likely to be higher. It's going to pick up because there has been a bit of a slowdown in some of the key ministry spend. But the government here is extremely clear that there is no question of them undershooting the FY24 budget estimates in any way. Hence, over the next 2 odd months, it's going to be interesting to watch out what are the important policy announcements which are very much on the table.
Okay, Sapna, we will look forward to hearing more. Thanks very much for joining us. Now, the U.S. International Development Finance Corporation will invest $553 million in Adani Port's joint venture in Sri Lanka. This investment in the Colombo Port Terminal project is the first time that the U.S. government is funding an Adani project through one of its agencies. The company's shares surged in trade on the back of that news. This is an attempt by the U.S. to curb Chinese presence in the area. Remember, Sri Lanka's Hambantota port is currently controlled by China. On to another CNBC-TV18 exclusive this evening. Relega Enterprises has kick-started the process to list its health insurance arm, Care Health, on the bourse. Sources have told us that the company is looking to raise between 1,500 to 2,000 crore rupees. The IPO will consist of both primary as well as a secondary issuance, and its proceeds will be used to enhance solvency and fund growth. India's largest domestic airline, Indigo, expects nearly 75 of its aircraft to be grounded by March next year as Pratt & Whitney accelerates engine inspections. Now, Indigo expects 30 to 35 more planes to go out of service by March, but the groundings have not had any noticeable impact on Indigo's operations just yet. Madiha joins us now to take a look at Indigo's performance in the last 5 months and how it intends to navigate the challenges. Madiha, so take us through what we can expect now in terms of contingency measures by Indigo.
Well, 75 aircraft is not a small number. In fact, it is an entire fleet of some smaller airlines like SpiceJet and more than double of young airlines like Akasa Air. Indigo already had many aircraft on ground, with Pratt & Whitney not being able to deliver the engines on time. The groundings accelerated, as you said, after August, when Pratt & Whitney announced it will recall 1,200 engines in the next 12 months. Now, Indigo told CNBC-TV18 that over 40 aircraft are already grounded due to the engine inspection. The airline yesterday said it is expecting 30 to 35 more planes to be grounded by March next year. Now, that will take 75 of its planes out of service. Let's look at how big a dent this will make for Indigo. According to Plane Spotter, Indigo has the largest fleet in India with 344 aircraft, of which 51 planes are parked and 293 planes are in service. So even with the groundings, Indigo still has the highest fleet among all Indian airlines, and that is how it has consistently grown its market share in the last 5 months, from 61.4% in May to 63.4% in September. It had a very low cancellation and passenger complaints rate as compared to other airlines, and it also maintained an on-time performance of over 80% in the last 5 months. In fact, it was on number 1 for the last 3 months. And despite the groundings, Indigo is very confident of meeting the capacity guidance of 15 to 19% in FY24. And as it is mitigating its measures, Indigo told CNBC-TV18 that it has retained 14 older aircraft, extended leases on 36 aircraft, and will lease 11 aircraft in November and 12 aircraft in January. So the airline is increasing capacity to offset the impact of the groundings.
All right, Madhya, many thanks for joining us. That's Indigo dealing with engine-related issues on account of a global recall by engine maker Pratt & Whitney. And Madhya is taking us through the contingency measures that it is putting in place. Now, in a bid to boost EV manufacturing in India, the government is mulling import duty cuts on fully built electric vehicles if they are made in India. Sources say a high-level meeting took place at the PMO with top cabinet ministers in attendance to discuss ways to attract players like Tesla and others. Pariksha joins us now with more. Pariksha, take us through what was discussed at the meeting. Now, the big ask from Tesla and others has been that, look, let us import to start with, and then eventually, given the size and the market opportunity, we will look at domestic manufacturing. How is the government now responding to this?
Well, we have to say those negotiations still continue between Tesla and top levels in the Prime Minister's office, the DPIIT, the Commerce Ministry, the Heavy Industries Ministry as well. So where are things? Well, very recently, there was a meeting of top ministers in the Prime Minister's office. They took stock of where our EV story stands as of now, what can be done to attract the likes of Tesla to India, and what more incentives can be given to the EV industry. There will be no special concessions for Tesla. That has been made completely clear by the Indian government. But what is now being considered is a larger policy which helps all EV manufacturers and any EV company wanting to enter India, including Tesla. And this will be, they are considering reducing duties for companies which give a certain commitment to invest and manufacture in India. So there could be a investment threshold. There could be a time period for which that particular company could get a duty concession. But currently, these are thoughts. These are proposals which are being considered. There is no concrete announcement as such. No stakeholder consultation has taken place. We are told the DPIIT, the Commerce Ministry, is leading these discussions as of now. Tesla had sought a duty reduction to 40%. Currently, importing fully built-up cars costing up to $40,000 attracts a duty of 70%, and cars costing more than $40,000 attract a duty of 100%. Now, this was not acceptable to Tesla. Having said that, the government also believes that there are a number of schemes, such as the PLI scheme for auto and auto components, the PLI scheme for ACC, the FAME scheme, which are all there to incentivize electric vehicle players. A FAME 3 scheme is also on the cards. And even if that does not happen immediately, the FAME 2 scheme may be extended in the vote on account. So this is what we are hearing. Also on cell manufacturing, the government is very bullish that cell manufacturing in India will begin by February next year. So there will be a whole local ecosystem and local incentives which will help companies like Tesla.
All right, Pariksha, appreciate you joining us. So no final decision yet, but talks underway. Moving on, air quality remains hazardous across Delhi and large parts of North India. The Delhi government has announced an early winter break for schools, which will now be shut from the 9th of November to the 18th. Also, after a wrap from the Supreme Court, Delhi's Environment Minister Gopal Rai said that the odd-even scheme will be implemented only after the Apex Court reviews its effectiveness. Yesterday, the top court had questioned the efficacy of the car rationing scheme. Air pollution has pretty much brought most construction activity to a standstill. How does this impact industry? Timsy is standing by now with more details. Timsy, you've been speaking with industry players. Take us through the impact of the measures being announced, not just here in the NCR, but in other parts of the country, including Mumbai.
Well, that's right. The real estate sector has been hit hard by the construction ban in Delhi NCR due to the air pollution guidelines. Remember, the construction ban is actually causing a delay of 5 to 6 months in the delivery of housing units. That's what industry estimates tell CNBC-TV18. Also, remember, this particular sector, that is the real estate sector, is one of the largest employers for the unskilled laborers who are right now sitting idle. And in most of the cases, these laborers have migrated to their hometown for at least 2 months. There are several lakhs of laborers who are displaced right now, and they are sitting with no salaries due to the ban, because these are daily wage laborers who are employed at these construction sites, and they are sitting idle. The ban is also impacting sectors like marble industry, steel, cement, furnishing, tiles, fittings, ceramics, etc., who are actually the supply chain for real estate sector. Also, the ban on diesel vehicle movement is also leading to a further disruption in the supply chain. When it comes to a survey, well, ANAROC study says that about 3,27,500 housing units are currently under construction in Delhi NCR, and they are impacted. To break down this number, 1.25 lakh housing units are stuck in Noida, Greater Noida alone. 1.23 lakh housing units are stuck in Gurugram, and about 79,000 housing units are stuck in various parts of Delhi, Ghaziabad, Faridabad, Bhiwadi, etc., which are impacted through this ban. Let's see what is the fate of these units. Back to you.
Timsy, many thanks for joining us. Now, this October has been the hottest on record globally, with exceptional temperature spikes and destructive weather extremes lashing across the planet. This, as per Europe's climate monitor, temperatures were 1.7 degrees Celsius warmer than pre-industrial average for the month. This marks the 5th straight month with such temperatures, making 2023 the warmest year ever recorded. Well, that is climate change for you. And time for us to head into a break. But up next, the health check of corporate India. Ritu will be joined by India Ratings Outlook's Vivek Jain on the findings of their report. That and more when we return.
Well, India Ratings and Research has maintained an overall stable rating outlook for large corporates for the second half of the year, and this is on the back of a broad-based recovery and improved balance sheets through this cycle. Of their rated portfolio, 82% has a stable outlook, unchanged year-on-year, and it also finds that barring export-oriented sectors, recovery in large corporates has been generally broad-based. While balance sheets of corporates have improved, household leverage, in fact, has crept up, and government deficits also remain fairly elevated. And as a result, sectors like commodity, chemicals, construction, textiles, and Tier 2 realty players could remain vulnerable to a slowdown in growth and elevated costs. This is the findings of the report, and joining me now to discuss it is Vivek Jain, the Director of Corporate Ratings at India Ratings and Research. Vivek, welcome to CNBC-TV18. Thank you very much for your time here. You know, a stable outlook for the second half, your report says, but the theme of bipolar recovery, doesn't that continue to play out with some of the sectors recovering better than the others? And even within segments, isn't that playing out? So what are pockets of stress, and which are the pockets that are now emerging out of the woods?
Thank you so much, Ritu. Our pleasure is completely ours. So I think from a directional perspective, if you were to look at either, as you rightly said, it's been a broad-based recovery. But from a sectoral mix, if you look at three sectors we have specifically pointed out, which we believe could be in the woods for some time, they are largely textiles, construction, and Tier 2 real estate. And within sectors also, we are seeing a K-shaped recovery, whether you look at autos, where cars are selling more, higher-end cars are selling more. Similarly is the case on the real estate side, where Tier 1 developers are doing far better than Tier 2 developers. So it's visible in sectors also, within the sectors and across the sectors.
You know, Vivek, what about capex expenditure? That's kind of remained uneven. We've been seeing more brownfield expansion than greenfield from corporates in the last few years. What about government schemes like PLI, for instance? Are they moving the needle when it comes to manufacturing? And is it showing in the numbers yet?
Right. So capex, I would say, has been not very broad-based. It's occurring in select sectors. Like we typically say, three sectors account for bulk of the capex, which is your power, oil and gas, and the EPC segment, so to say. So these three segments, would account for the bulk of the capex, and that continues to happen. Right. So there is, I would say, limited pockets where we are seeing, and incrementally the capex is largely brownfield rather than being greenfield, which is the point when you really start seeing those, animal spirits back in people spending on new capex. So that seems to be missing. We are still on that brownfield mode, where incremental capacities are small percentages of existing capacity. You could say the capex mode would be full blown out when you see an announcement coming, which is, let's say, X percentage, which is above 20% of the existing capacity. So those seems to be, missing, and people are doing modular capex, so to say. It's still not, whole hog out and doing and setting up a project in bulk. It's still modular in nature. On the PLI bit, we are seeing select sectors where PLI has picked up, and people are putting up capex in order to take those benefits. But still, the underlying driver still has to be the demand. Ultimately, the product has to be off-taken. Only then the PLI can support. Right. So we have seen some sectors take those benefits, but otherwise it has been limited to a few sectors. And lastly, we have seen capex pick up in sectors where China plus one or Europe plus one in that sense has played out to their advantage. So those would be some places where capex is largely visible.
But Vivek, do you have a sense of what kind of capex is planned for the remaining half of the year? And, what are the specific industries that are benefiting from this China plus one strategy already?
Right. So I think the typical names that we, usually when we speak to the corporate clients, the people who seem to be doing a lot of capex on these sides are largely on the chemical side. You would have somebody doing, capex on specialty chemicals, And some of these related chemical side is one place where we feel it's largely taking place. But otherwise, exports seems to be picking up in a lot of other areas also, like capital goods is one example. But that might not be purely a China plus one phenomena. It could also be because of the investments, let's say, the US and Europe are doing in terms of greening their own grids. So, it's difficult to segregate, but wherever export-facing, businesses are there, we are definitely seeing some momentum, barring the sectors that I initially spelled out, where, the likes of textile, where we are still seeing some kind of a pushback in terms of offtake. But otherwise, in some of these sectors, which are largely dominated by China, we are seeing people put up capacities in India, where exports could be done. Pharma is another example, where we have seen a lot of, and pharma India happens to be the global pharma, capital from that sense. So you've seen fair amount of capex happening from that perspective.
Okay, that is as far as capex is concerned, but what about financing for it? If you look at the bank numbers, we've been seeing solid advances growth in double digits, but a lot of it is focused on retail, not so much on corporate. And even in capital markets, as we've continued to see, the better rated, larger corporates are able to get financing at better rates than some of the others. Is the condition improving much, or, how's the market looking at the moment?
Right, so it's a great question. So I think if you look at our portfolio also, right, bulk of the action. So if you look at 82% of the portfolio is rated as stable, remaining 10% is positive, and 8% we are saying is currently with a negative outlook or a negative directional indicator. Now, large part of the negative actions that we see are restricted to the bottom end of the rating curve. You could have from an A- to a triple B, but largely restricted to the triple B category and below. Now, what that seems to suggest is two things. One is credit availability at the bottom of the cycle, bottom of the curve still remains limited. So there also you have that K-shape which we just talked about. It's not just on the corporate side, but also from a lending perspective. Banks are wary of lending to corporates at the lower end and very happy to lend at the corporates, who are rated highly. And similarly, the liquidity also plays out in the same fashion. So corporates who are rated better, who enjoy a better rating, have been able to access markets, are not facing that heat of rise in interest rates or availability of liquidity. But somebody who is lower down the pecking order is definitely feeling those heats, and hence those ratings which we have on a negative outlook also reflect those liquidity pressures which we believe would have played out.
Vivek, a quick clarification. The distribution of your rating outlook, that is a marginal negative skew when you compare it to the distribution of sectoral outlook. What explains that?
Sorry, Ritu, you'll have to come again. I couldn't catch that.
Well, the distribution of your rating outlook, that has a bit of a marginal negative skew when you compare it to the distribution of your sectoral outlooks that you've given. What explains that difference? Because overall, the outlook is stable for 82% of your rated portfolio.
Right. So there are two different, two ways we assign these outlooks. One is what we call as the sector outlook, and other is what we call as the rating outlook. So rating outlook is for companies that we rate, the portfolio that we have, while sector outlook is at a broader level. So, we could be observing stress in something that we don't rate, or, it's a general comment about the sector per se. So the sector bias could be negative because we are seeing, as I said, if you look at the distribution of corporates also, so beyond 500, there's a long tail, right? So a number of corporates which are seeing those stress, as I said, in the lower rated portfolio could outweigh the portfolio that we have, right? Our portfolio can be, let's say, it's largely, a good portfolio which is visible. 82% is, rated strongly. So those differences can arise when you are taking a call on the sector versus rating your own companies in that sector.
Vivek, we have 10 seconds to go, so just a one-line answer. The top 2 to 3 risks for the corporate sector in the coming months?
So I think it's the K-shaped recovery, availability of credit and the cost of credit. And third, if capex picks up meaningfully, then are the balance sheets deleveraged enough, or would they re-leverage pretty fast? So these would be the top 3 risks that I would think.
Okay, Vivek, thank you so much for taking us through that. Thank you very much. It was a pleasure speaking with you. But on that note, we're going to wrap up this edition of Business 360. Thank you very much for watching. But stay with CNBC-TV18. News and updates will continue.